Welcome to today's explainer. Look, if you've been watching the oil market lately, you know it's acting exactly like a roller coaster right now, and one that just took a pretty terrifying plunge. Prices for crude have been rapidly plummeting. The main driver? It's right there in the headlines. Now, the war in Iran isn't officially over just yet, but the market is heavily anticipating its eventual end, mainly because prolonged fighting simply makes zero economic or strategic sense for anyone involved. So today, we're going to peel back the layers of this market and uncover what actually happens when all this dust settles. Basically, the brakes are off. For months, we had this colossal war premium baked right into the price of black gold. The market was absolutely terrified, pricing in these truly apocalyptic scenarios from our source data, things like the complete closure of the Strait of Hormuz, the destruction of critical Gulf infrastructure, and just a massive global supply shock. But as those geopolitical risks rapidly decrease, that war premium, it's evaporating right before our eyes. And as a result, traders are dumping their futures en masse. And, that dumping has sparked a familiar panic echoing across the news. We're seeing quotes like, "This is the end. Nobody needs oil anymore. There is only a fall ahead." It's a very dramatic, surface-level myth, but it's a narrative that literally always reemerges the exact moment prices take a hit. Which brings us to the core question of our explainer today. With the war premium vanishing, is this actually the end of oil? Okay, let's dive into this. We need to pivot away from all that emotional geopolitical noise. We're going to look at a real long-term assessment of the market based on our sources and figure out where the fundamental bottom truly lies. Section 1, the green transition illusion. So for years, ESG and green energy advocates have been telling us that oil is a dying asset, right? That electric vehicles, wind turbines, solar panels, they're all about to send the internal combustion engine to the ash heap of history, and global demand is just going to collapse. But the reality is a lot harsher and much more technologically complex. While the West, primarily Europe and the US, is reporting growth in EV sales and renewables, the global South, including places like Asia, India, Africa, Latin America, they are on a completely different trajectory. They're building factories, paving roads, and aggressively increasing energy consumption in totally traditional ways. I mean, they desperately need diesel for their trucks, fuel oil for their ships, and petrochemicals for literally an entire spectrum of consumer goods, from plastics to fertilizers to asphalt. You just can't disconnect the physical economy from hydrocarbons at the snap of a finger. And because of that continuing development, global demand isn't disappearing. 100 million. The world still consumes over 100 million barrels of oil every single day. And here's a super fascinating detail from the source material. We actually live in an era where the need for energy is growing, thanks to the explosive development of data centers and artificial intelligence. These require absolutely enormous capacities for electricity generation, which indirectly supports the traditional energy balance to a massive degree. Now, obviously, the green transition is real, and it's totally possible that oil consumption won't actively grow forever. Let's just say that over the next 10 years, global demand smoothly declines to, say, 90 million barrels a day. The market bears think that's a death sentence, but they're only looking at the demand curve. The other side of that equation is the supply curve shift. While demand might be preparing for stagnation, the supply curve is undergoing these colossal, under-the-radar shifts that are actually going to prevent the price from drastically falling. Section 2, the $60 iron floor. See, when geopolitics fades into the background, pure mathematics takes the stage. The main argument against an endless fall in oil prices lies right in the dirt, in the actual process of extracting it from the ground. Think about the sheer scale of this extraction for a second. 365 billion. If we consume 100 million barrels a day, that equals 36.5 billion barrels a year. At those rates, over just the next 10 years, the planet is going to pump 365 billion barrels of oil out of the ground. What does that mean? It means the era of easy oil is completely over. The giant, easily accessible, dirt-cheap fields of the 20th century are rapidly depleting. So, to replace those depleting, cheap reserves, the industry has to develop new fields, which brings us to the marginal cost of production. Basically, this is the base cost required to extract a commodity from new, complex, and hostile environments. We're talking about deep water drilling on the shelf, the freezing Arctic, and shale basins that require continuous, highly expensive hydraulic fracturing. And over the past few years, inflation has rolled like a steamroller right across the sector. The cost of metal for pipes is way up, rig rentals are way more expensive, and the salaries for qualified engineers have totally skyrocketed. The capital expenditures for every single new barrel are steadily creeping upwards. And that brings us to a crucial point. perfectly captured by this analogy from our source material, the desert caravan. Look, a caravan always moves at the speed of its slowest member, right? Similarly, the market price of oil is balanced against the cost of the most expensive field that is physically necessary to meet market demand. So even if 80% of oil fields have a relatively low production cost, the market is still completely guided by that top 20% of highly expensive fields. Because without that top 20%, we'd face a severe physical deficit. In this, extraction math creates this automatic market reaction. It's like dominoes. Step 1, if prices drop below the $50 to $60 range, they fall below the development cost of these complex projects. Step 2, oil corporations, who are still scarred by previous crises, simply refuse to operate at a loss, so they heavily cut their investment budgets. Step 3, drilling rigs stop, new projects freeze, and unprofitable wells get plugged. And step 4, this instantly creates a supply deficit, which inevitably forces prices right back up. This natural fundamental floor is significantly higher today than it was just 5 to 7 years ago. We literally just cannot produce cheap oil in those previous volumes anymore. Section 3, just in case strategic reserves. So there's a second massive reality holding the market up right now. Over the last few years, especially with the recent escalations in the Middle East, global governments have learned an extremely harsh lesson about how incredibly fragile their supply chains truly are. For decades, the global economy lived in this just-in-time paradigm, minimizing storage to save costs, basically assuming a tanker would always arrive exactly when needed. But the threat of blocked straits and sanction wars shattered that illusion. States are now shifting rapidly to just-in-case logistics. Major importers like China, India, and Europe realized their critical vulnerability. If physical supplies are interrupted for months instead of weeks, it means the total shutdown of their industries, massive energy hunger, and ultimately a social explosion. So they're building these massive 90 to 180-day guaranteed safety cushions. And this fear is launching a colossal process right this second. We're seeing an absolute boom in massive new infrastructure. Sovereign states are pouring investments into designing and building giant tank farms, hollowing out underground salt caverns, and securing floating storage facilities. And obviously, all of these new enormous tanks need to be filled with something. This introduces a key driver that really isn't fully priced into the market yet, the vacuum cleaner effect. The formation of these national safety cushions creates this giant, guaranteed, and inelastic demand, meaning they are going to buy oil regardless of normal market fluctuations. These government purchases will act like an enormous vacuum cleaner. If a surplus arises and panic pushes the price down momentarily, these national reserves will step right in and buy up the cheap volumes, instantly leveling out the balance. And since you can't just build and fill a mega storage facility in a month, this is going to provide stable, additional demand for years to come. Section 4, the true value of oil. As we wrap up this explainer, it's super important to remember why we shouldn't panic alongside the day traders looking for short-term profits on the news of fading geopolitical tensions. Let's compare the myth to the reality. The surface myth tells us this is the end of oil and demand is plummeting. But the deep reality? It's entirely different. We have two curves that will inevitably intersect. On one side, you've got steady demand from developing economies and the petrochemical needs of developed nations. And on the other side, you've got the growing cost of production, permanently cutting off the era of the cheap barrel, combined with this massive global trend of state reserve buying that will smooth out any price drawdowns. So, we return to the question we asked right at the beginning. Where is the fundamental bottom? If the cost of keeping the world running has fundamentally shifted and global governments are acting as a buyer of last resort to protect their citizens from an energy collapse, where does the price actually stop falling? Well, according to our source analysis, that fundamental wall is $60. Oil remains the circulatory system of the global economy. Those trying to bury this asset today risk being very, very surprised to find that in a new, pragmatic, and honestly slightly more dangerous world, the value of a guaranteed barrel sitting in a storage tank only increases. The market will inevitably bounce off this $60 floor in the long term. So as we see these geopolitical shifts play out, ask yourself, in a world switching to just-in-case survival, are we vastly underestimating the true future cost of our global energy security? Thanks for joining me on this explainer, and keep your eyes on that floor.